This video has Chapter 12 examples. So in Chapter 12, we look at capital budgeting decisions. And the main thing that we have to consider in capital budgeting decisions is what the cash flows are for the decision, what the relevant cash flows are. We have a lot of information here about a company, and they are looking whether to expand into a new business that has revenues of $5 million and cash expenses of $3.6 million. They have a current level of investment of $12 million. They estimate that working capital of $30,000 will be needed. We're going to have additional cash expenses of $400,000 a year. Raw material costs will be $1.2 million a year. The CFO estimates that we need a new machine with a 7-year life and estimated salvage. We're going to use straight line depreciation for tax purposes. Our weighted average cost of capital is 14%, and our tax rate is 40%. So we have a whole bunch of information, and we need to look at what is the various different parts of information, what is relevant and what isn't. So first we're going to look at time zero. Time zero is right when we put the project into placement. So this starts with the acquisition cost of the machine and any expenses involved with putting the machine in, and our working capital requirements. So the cost of the new machine is $2.5 million, and we have a working capital requirement of $30,000. So our total at time zero is $2,530,000. Now we're going to figure out what our cash flows are going to be for years 1 through 7. So we have projected cash revenues for this project of $3.6 million. So annual cash revenues, $3.6 million. Okay. Then we have our additional expenses. So we have some additional overhead, $400,000 in cash overhead, an additional $1.2 million in materials, and an additional $1.2 million in labor. So our total additional. Then we also have depreciation. So our depreciation, we're doing straight line depreciation. So we use the straight line depreciation calculation in Excel. We have the cost, our salvage value, and our useful life. So we have $300,000 in depreciation. So we add up all of our expenses, revenues minus expenses gives us our incremental operating income. So then we calculate our tax, which is 40%. So 500,000 times 40%, and we subtract our tax expense, and that gives us an after-tax operating income of $300,000. We now add back the depreciation because depreciation is a non-cash expense. So we have annual after-tax cash flows for this project of $600,000. Then at year 7, we have the recovery of our working capital. So recovery of working capital, $30,000. And we have the salvage of that machine of $400,000. So our total recovery, or in year 7, is $430,000. So those are the relevant cash flows for that decision. The next thing we're going to look at is a couple of different depreciation methods for a piece of equipment and how depreciation changes what the tax savings is. So we're looking at the tax savings of different depreciation rates compared to the straight line rate. So we start with the sum of years calculation and the straight line depreciation. So we have the SYD, or sums of years digits depreciation. We need the cost, the salvage, the life, and then the period is the year here. So we select cost, salvage, life, and if we lock all of those cells, then we can copy our formula. We then select year one, and we can copy this down, and that gives us our sum of years digits every year for depreciation. Then we're going to calculate straight line depreciation. So we need cost, salvage value, and life. Straight line is, need to lock those so we can copy them down. Now we're going to look at the tax savings. So depreciation gives us a tax shield. So we can, because we don't pay cash out, but we do save on our tax payment because of our depreciation expense. So now we're going to calculate what the tax shield is on our depreciation. So that is our depreciation expense times our tax rate. And then we will do the same for our straight line, depreciation expense times the tax rate. We're going to compare the present value of the tax savings on the sum of years digits depreciation and the present value of our tax savings over 4 years of straight line depreciation. So we'll use the net present value function. Our rate is 8%. And then our values, we're doing the sum of years digits here. And then we need to put a 0. And then we'll calculate the net present value of the straight line, rate, values. Okay, and that gives us the net present value. Now the difference between the tax savings. So we see that the present value of the sum of years digits depreciation is higher than the present value of the straight line depreciation. Okay, now we're going to compare double depreciation, double declining to straight line. So the straight line is all the same. Okay, and double declining. So we have cost, salvage, life, and we want to lock all of those cells and then select the year. Okay. And in year 4, we need to force the depreciation because there is no salvage value. So then we would take our depreciation expense times our tax rate to get what the tax shield is for our depreciation. Then we'll calculate the net present value. Our rate is 8%. Okay, and straight line is the same, and the difference so we would try to decide which depreciation rate was the most advantageous to us for the tax shield that it gave us for when we're calculating cash flows. Now we're going to look at makers. And for makers, we take the rate times the cost of the equipment. So these are from the table in your textbook, and makers is the IRS's depreciation rate. So we take the cost of the equipment times the tax rate for each year. Our straight line is the same. And then our makers depreciation times our 40% tax rate. And then our net present value, we have a rate of 8%, all of our cash flows. Okay, so with all of these calculations, we see that the best depreciation method for us, the most advantageous for our cash flows, is the double declining balance.